Headline GDP data came in stronger than expected Friday, but how should investors react? Joining me today, George Gero is the managing director of RBC Wealth Management. George, good to have you on the phone. Thanks for joining me.
Well, thank you for having me on the show. I appreciate it. I think you're one of the few very knowledgeable people that handles these shows.
Well, I appreciate that, especially coming from you, George. So let's talk about the big news today. Gold now trading near its highs for the week, despite these strong headline GDP numbers. So what does this imply?
It's interesting that gold in the just last few sessions is learning to live with a strong dollar. And the reason for the strong dollar hasn't really been the possibility that the Fed is going to hike rates again. Actually, traders are all keying on the next May 1st Fed meeting, which could be very, very interesting for traders. To see if the fact that these strong GDP numbers today will bring back some talks about maybe, after all, there could be a rate hike. But it doesn't look like it, as 22 countries around the world have lower rates, and key central banks keep lowering rates because economies elsewhere are not booming like they are in the U.S.
But George, that's an interesting point you make, that it might be that gold is learning to be so dependent on the dollar. But, why now? How come?
Well, until now, the expensive price of gold translated into dollars kept a lot of people at bay. They were unable to buy gold in those countries that needed it most, like Venezuela and Greece and Argentina and Brazil and many other countries, and of course even in the Far East. And then of course the opportunity cost of gold contrasted very sharply with the negative yields of many key countries like Switzerland and Germany.
So if I have to ask you, George Gero, drilling it down to its components, is today's data really good news? Personal consumption was up 1.2% and inventory built up. Does this really signal strong growth to you?
It does signal strong growth. I think it will continue to help the U.S. employment figures, but more important than strong growth, I think it will bring inflation down the road back to the headlines. And I think you're going to see inflation for more than one reason. Besides the fact that other currencies are weak, the euro is weak, and then, of course, some Asian currencies, and then, of course, some South American currencies. So it isn't just the weakness of other currencies that keeps the dollar up, but the ability for international investors to invest in the U.S. and the need to buy dollars to pay for that investment keeps the dollar strong.
So were you surprised by the results, by the data?
I was surprised to the extent that it has done so well. I expected good data because I have seen that the good data has kept pushing the stock and bond markets in the U.S. to highs, and because of that, that caused a strong dollar. And then the strong dollar, of course, was a headwind for gold in its pricing. But recently, you've had India buying gold, you've had China buying gold, you have the Russian central bank buying gold. Only U.S. investors were not buying gold because they were enticed by the strong stock and bond market.
Interesting. I always appreciate speaking with you, George. You make so much sense. Thank you so much for joining us.
Thank you for having me. It was really good.
Thank you, George. And thank you for watching. We'll be back next week.